Hello, everyone, and welcome to Introduction to Managerial Accounting. So, today we are going to talk about Chapter 1 and 2. Once again, this is me, your instructor, Gurpinder Gill, or Guru, whatever you want to go with. So, let's get started. So, by the end of this chapter, we should be able to achieve these learning objectives. So, which are we can define the managerial accounting and distinguish it from the financial accounting perspective, describe the role of management accountants, explain the importance of ethics. We will be discussing cost categories and what they mean, how to interpret them, and how to analyze them. We would also be looking at preparing schedule of cost of goods manufactured, which is used for manufacturing businesses. And finally, we will prepare an income statement for a manufacturing company. So getting right into the coverage, let's look at that. So management accounting and the business environment. So the managerial accounting, the managers have to perform different types of activities in the business world, such as your planning, directing, motivating the employees, controlling, and finally decision making. So decision making happens to be at the crux of managerial accounting process. So the management accountants provide the information to managers for use in planning and controlling operations as well as decision making purposes. They are required to have competencies in cost management, performance management, financial and non financial aspects of it, process management, risk management, and they often play a role in decision making across various functional areas of the organization. The accountants, whether they are financial accountants or managerial, they generally occupy a position called as controller. The controller position then reports to chief financial officer at the business. Okay, now to give you an example, so with these COVID-19 scenario, our business, like any other business, had to move um, from the work from the office setting onto the remote work scenario. So we as managers had to go through a step process. We had to plan, we had to look at defining the outcome, which was, in my case, was to complete my month end activities, my year end, and the audit work. Okay. Then I had to make sure that we were directing and motivating the staff. So we had to come up with ideas on how to move the the work or the operations from in-office setting to remote setting. What were the needs of the employees? What would they need over and above the technology in order to be successful? Okay. Did they have internet connection? Did they have a computer? Did they need dual screens? Did they have other technologies that were needed, such as a phone? Okay. So that is um, planning the process of moving from work onto a remote scenario. Now, with regards to the controlling, I had to make sure that once we had moved all of the employees from the in house office setting onto the remote locations where everyone was working from home. Now, how do I make sure that the quality of work does not suffer and the volume is there? How do I ensure the employees are performing the same level of work they would have done in the office? That's where your controlling aspect comes into play. So I started watching for their weekly and monthly output reports and paying more attention to the errors, to the process flows, and see what was the quality of the output. Was it any different? Okay. Realizing that information is, or knowing that information is one thing, but taking that information and processing and making a decision is entirely other. Okay. So once we had this information to look at, we analyzed that information. And as we went, we made those finer tweaks and changes to enhance our process. So, one of the changes that I did in my work environment was to reallocate work. So, when I started looking at these reports, I started realizing that certain employees were working harder compared to the others. So there was disparity in the workload. So we made sure that that was taken care of. So in the managerial accounting world, the managers always come across lots of information. They should be able to take that information, process it, and make something meaningful out of that information, analyze that information, and see how they can enhance the internal processes. Okay, now most of you guys, I'm assuming, would have taken accounting 2121 in the recent past. Okay, so that is accounting 2121 is your financial accounting piece. Accounting 3224 is built around managerial accounting. So entirely two different perspectives. So let's take a look at this and see how are they different. What is management accounting and what is financial accounting? Now, if you look at the way the arrows are pointing on the financial accounting and managerial accounting, your financial accounting arrow is pointing towards the left. Your managerial accounting arrow is pointing towards the right. So the way to interpret that or to think of this is one is looking in the past, the other is looking in the future. So your financial accounting, now these financial accounting or the financial managers or just the controllers, they are responsible for preparing financial information for the business. And that information, which is generally in forms of your financial statements, those financial statements are used by people outside of the organization, such as the owners of the business, the creditors, which could be your bank or the lending institutions, tax authorities, such as CRA, and regulators, which is your Securities Exchange Commission or Ontario um, Commission. Okay. So these external parties would use that financial accounting information. Whereas for the managerial accountants, we prepare the information for internal use. So the reports that the managerial accountants would prepare are used for planning purposes, directing and motivating, controlling, and performance evaluation. So, the example that I was giving you with regards to remote work situation falls under a managerial accountant's area. The financial accountants, their roles or jobs are always based on the past activities. So the financial accountants will capture all of the financial activities in the past, and those financial results are then converted into financial statements and presented to external users. Whereas for the managerial accountants, their outlook is always forward. They are always looking into the future. So these guys would always look at the information to analyze it and make those decisions for the future. How can we analyze the information we have today in order to make future decisions? That's where managerial accounting lies. Now, the financial accountants, their emphasis always is on objectivity and verifiability. Now, if you guys remember from Accounting 2121, one of the things that we harp on is verifiability to say the financial information that the business presents on their financial statements has to be verifiable. For example, if the business says they had $100,000 of cash in their bank account at the end of the year, that $100,000 have to be verifiable. Usually, you can look at the bank statement at the end of the year to say whether that number ties or not. Can you verify the data or not? So, financial accounting emphasizes on verifiability and objectivity of that data. On the other side, the managerial accounting piece, these guys would focus on relevance and timeliness. So, having said that, the financial accountants would always have accurate information because they are reporting on past transactions. You don't have to guesstimate anything. Okay. Um, so when you're looking at your cash, the cash is there, it has to be verifiable. So the financial accountants will capture the past transactions. So that is solid data. But when we talk about managerial accounting, since the managers are looking into the future, when they are looking at relevance and timeliness, they somehow or sometimes have to give up on verifiability. So they end up working with estimates. A lot of time in managerial accounting, the managers would end up working with estimates. That's the best information available. Based on that information, the managers make their decisions for the future. Okay, so this is what we were talking about. The financial accountants would emphasize on precision, having accurate data since it comes from past transactions. That's very doable. But for your managerial accountants, timeliness is a big selling point. You need to have the information available in time to make those decisions. Okay. Now, with regards to timeliness, I'll give you an example. So, I work as a controller with a mining business, and our office is located in Calgary downtown area. So one of the very frequent analysis we do is of our customer base. We started realizing that some of our customers are uh, needy. Okay, so we started seeing an 80-20 rule. What that means is 20% of our customers were actually causing us 80% of the workload. Okay, so we started to look at that information and started analyzing this information to see what's our customer base, what kind of revenue they bring in, what are our margins on each one of these customers. That determined how we should be treating them in future. Should we giving them the same amount of attention or should it be any different? So once we ran this analysis, we figured out which were our top customers, where did we need little bit of um, um, more managing, or on the other side, not to pay enough or not to spend enough time on the customers because those were low volume. Okay. So when it comes to management accounting, the big question is not if the information is required. The big question is, can the information be used for something, um, some decision making in the future? Okay. Is the information beneficial? Can you use the information to for some analysis? That's the premise of your managerial accounting. Now, managerial accounting does not follow any accounting guidelines. It does not have any set of rules or guidelines to follow. So, managerial accounting has no dependency on GAAP, which is your generally accepted accounting principles. Whereas, if you look on the other side, your financial accounting or your financial managers, all the financial statements prepared under financial accounting has to be in compliance with GAAP. So generally accepted accounting principle, that is the deciding guideline that we have to follow when we do financial statements for external reporting. Okay, now that is the tricky part with the managerial accounting because there is no set guideline or no requirement. Often this piece can be overlooked. It really depends on the manager as to how well they understand their business environment, how well they understand the data that they have, and how can they take that data, analyze it, and make some good decisions out of that data analysis. But nobody is going to ask these managers for a certain items to be done. So the idea is for a managerial accountant, they can analyze as much as they want or as little as they want because there is no guideline with regards to this. Okay, so as we said, following the GAAP principles under the financial accounting set is mandatory for external reporting purposes, but when it comes to managerial accounting, we are not mandated to follow any set of accounting principle. Entirely depends on the manager, how well they understand their business and their data, and have the ability to analyze that information. Ethics. Now, ethics have gained a lot of momentum in the last decade. So the companies should be concerned about their ethical reputation. A company that is not trusted by its customers, employees, and suppliers will eventually suffer. In the long run, the very survival of the company depends on the level of trust held by its stakeholders. Now, the stakeholders are people who are within and outside of your business. Okay, now these are the guys who have an interest in the organization's activities. So, if you think of who these stakeholders are, they are employees, shareholders, creditors, customers, your suppliers, and the communities in general that the business operates in. So, organizations usually would prepare a code of ethics to reflect its values and moral system. Now, this document specifies what is expected of its employees in their dealing with their various stakeholders. Okay. So the code reflects what the organization stands for when it interacts through its employees with the other stakeholders. Okay. Now, as I had mentioned in my welcome message, that I like to use lots of examples when we talk about these concepts. I'm just going to throw another one in here. So I knew of a business. Um, so the business model was they would focus on collecting from their customers aggressively, but when it came time to pay their vendors, the business would delay that process as much as possible. At times, they would not pay their vendors for 4 to 6 months. On the other hand, they have collected from their customers in time, okay, anywhere between 30 to 45 days. Now, such behavior is seen as unethical. So when the businesses becomes unethical in their practices, they will suffer long-term challenges or losses or loss of customer base and vendors. And that is exactly what happened with this business. Soon, their customers found out about the business practices through their vendors. When you're operating in a small market, the chances are that everyone knows everyone. Okay. So with this business, the customers found out the business practices of this business through the common market. So the business ended up losing some of these reputable organizations that they were doing business with. On the other hand, they ended up losing some valued um, vendor base because the vendors did not want to do business with them anymore. The vendors were not confident that they will get paid, and if they did get paid, it would not be in a timely fashion. So the vendors did not want to take that kind of risk. Okay, so that is just one of the examples that I could think of right this moment. So that is about ethics. Now, the company will also establish a system by which it can it directs and controls, which is called as the corporate governance. The board of directors play a key role in ensuring effective corporate governance. And there are also legal regulations such as Sarbanes-Oxley Act in the US that lays down the rules for corporate governance. And in these recent times, we have also seen increased awareness and interest in corporate social responsibility, CSR, which refers to the idea that corporations should consider the needs of all stakeholders, not just the shareholders when it comes to their business decisions. Okay. For example, the impact of that business on the environment or the impact of that business on the society or the area they manufacture in. Okay, so that is corporate social responsibility. All right, so now we are moving into our cost terms, concepts, and classifications. So here we are going to look at our major cost classifications. Now, there are product cost and period cost. We will look at details of each one of this in a few minutes here, but this is what we will be talking about. So we will be discussing what's product cost, what's period cost, what makes a variable cost or a fixed cost, a direct and an indirect cost, differential, sunk, and opportunity cost. So we will be looking at each one of this in detail. So let's get to that. Okay, now why do we need to classify our cost? Okay, now generally, if we were talking about this in class, this is where you would get to have an input, or express your thoughts. But since this is a recorded session, I will keep going. So the businesses need to understand their cost classification as to what is their cost, how is their cost going to behave, because based on the cost classification, we then determine how this cost should be treated. Where should this cost sit? Would it affect your balance sheet, or should it go to your statement of profit or loss or income statement? That depends on the type of your cost and how your cost is going to behave. So we need to understand our cost, the cost classification, so that we can prepare our external financial statements. Now, if some of you guys remember from your prerequisite course, that is Accounting 2121, we would have talked about the product cost or the inventory cost. The product cost is made up of your direct material, direct labor, as well as your manufacturing overhead. Now, your product cost is part of your inventory cost. So when these costs are incurred, we debit your inventory account, not an expense account, which means your product cost or inventory cost will sit on your balance sheet or your statement of financial position up until that product is sold. Okay, we'll talk about that in the following slides there. But your product cost is a combination of your direct material, direct labor, as well as your manufacturing overhead cost. On the other hand, your period cost is expensed whenever it incurs. The other way of looking at your period cost is its non-manufacturing cost. Cost that is not helping you make a product is your non-manufacturing cost. Such as, so now your non-manufacturing cost generally are broken down into two categories, which is your marketing and selling cost, and the other one is your administrative cost. So, generally speaking, when I look at the cost in order to make a product, I always think of it in a slightly different way. Okay. And so that we can put it to the right spot, I always think of it in a slightly different way. Okay. Um, so again, coming back to my business, and the reason why I keep talking about my business is because I have spent extensive time. I understand the business process. I understand the nitty gritties there, and I understand the information, how it flows and how it affects. Okay, so that's the only reason I keep bringing my work experience into play in the classes so that we can make sense of this information. There is no other reason for this. All right. So, with my business, we are a mining business. We mine silica sand and we sell that sand to oil and gas companies for their fracking operations. Right? Now, we have a manufacturing facility in Alberta. We also have a couple of other locations throughout Canada, as well as we have our operations in United States of America. All right. So we have quite a presence in Canadian market as well as in US market. So the way I think of my cost and where the cost is originating is, so we have our head office in Calgary downtown area. So any cost that incurs in the head office is seen as period cost, which means it will be expensed as and when it incurs. So I always look at where is the cost originating. Is the cost originating at the manufacturing plant? Because if that's the case, then I am looking at product cost, which means it becomes inventoriable. If the cost is originating in our head office, then it becomes period cost because that is a non manufacturing cost. Just to put it in perspective, the kind of cost that happens in the head office is, for example, my salary. I'm the controller in accounting, so my salary is a period cost. Okay. No matter what I do, whether I work or I don't work, that has no bearing on the actual product that is produced in the manufacturing facility. That's why the cost associated to me is seen as period cost. It is expensed in the time it incurs, and we move on. And we will talk more about these costs as we go. Okay, we also need to understand our cost so that we can predict the cost behavior and how this cost is going to change with the change in activity level. Now, when it comes to changes in the activity level, the cost could go up, it could come down, or it could stay constant. That really depends on the type of cost we are looking at. So, variable cost and fixed cost is what we got to understand here. Fixed cost is something that is constant in total. It is not going to change on a total level, but the per unit cost could change. On the flip side, your variable cost is directly in proportion to the activity. The way the variable cost behaves is on a per unit level, the variable cost will stay constant. But when you look at the variable cost, multiply that with the activity level, the total would change. All right. So let me give you an example there. Let's say I have two kids. So let's say I ask them to take transit, and each transit ticket, let's say, is around $4. So the cost per ticket is constant. It's $4 per ticket. So if one of my kids take the transit, then my total cost is $4 times one person taking transit. So the total cost is $4. But if I have both of them taking transit, my per unit cost is not changing. It is still $4. But now my activity level is two people. So $4 of ticket per person, two people taking transit. So my total cost is $8. So that is how your variable cost will always behave. It remains constant on a per unit level, but it will change on the total because it's tied to the activity level. On the other side, let's say we decided that in COVID times we didn't want to do transit, so we called an Uber. Now, the cost of the Uber ride, okay, let's say the cost of the Uber ride is $20. That cost is fixed. I will have to pay $20 whether it's one person in that Uber or there are three. Okay? Uber or taxi, whatever you want to think of. Your total is the same, but depending on how many people take that, the per unit cost will change. Okay, we also got to understand our cost classification so that we can assign the cost to our cost objects, such as our departments and products. This is where we start looking at our direct cost and indirect. So, direct cost is anything that can be directly associated or traced back to a product. An indirect cost is something that exists. We know the cost exists, we know the material was used, but we just cannot relate it or trace it directly to a particular product. Okay. So, with regards to your decision making, we were looking at differential cost, sunk cost, and opportunity cost. So, differential cost is the cost associated to each alternative that we have. Sunk cost is the money that's already been spent. The cost has incurred in the past, therefore, should have no bearing on our decision for future. And opportunity cost is the cost of foregone benefit. Now, just throwing in an example there, let's say the classes were on the Mount Royal campus. So you have two options to get to the campus. One is that you drive to the campus, pay the parking. So the cost associated to fuel and parking is the cost, differential cost for you to drive to the campus. Alternatively, you could take the transit. So the ticket or the transit pass or the ticket that you take for that trip is your cost associated to taking the transit. So that's your differential cost between these two alternatives. Now, the sunk cost in this situation is the money that you've already spent on buying that car. So that money is already spent, regardless of what you do, whether you take the transit or you drive your car, it's not going to change. So that cost should not affect your decision or whether you will be taking the transit or you would be driving your car. So that's the sunk cost in this situation. And the opportunity cost. Let's say taking the transit takes you an hour and a half to get to the campus because you have to take few connections. On the other hand, if you were to drive, then it takes you about half an hour to get to the campus. Now, that difference of 1 hour, if you did, let's say you are employed and you are able to use that hour to work and make money, that is your opportunity cost because that becomes relevant now. The decision between whether you take the transit or you drive your car will be impacted by your opportunity cost because if you are taking the transit, then you are letting go on the benefit of driving the car where you could have made extra bucks. Okay, so that is your differential cost, sunk cost, and opportunity cost. Okay, moving on to our product cost and period cost. Now, remember, we were talking about the product and the period cost. So, the way I like to picturize that is I look at where the cost has originated. Has the cost originated at the manufacturing facility? Because if it did, then that cost at the manufacturing facility becomes part of your product cost. If the cost is related to your head office or a non manufacturing facility, then it is period cost. Period cost is generally categorized between marketing and selling and general and administrative cost, and it is expensed right away. On the other hand, if the cost is originating at your manufacturing facility, then we refer to this as product cost or inventoriable cost, which means the cost will go on to your balance sheet up until the product is sold. So, some sort of cost or some types of cost that can exist or can does make up a product cost is your direct material, direct labor, and manufacturing overhead. Now, all of these costs, your direct material, direct labor, and manufacturing overhead, they are added to the cost of your inventory. So they are recorded as the inventory cost, but when the inventory is sold, at that point in time, these costs are expensed. So that's where you would end up see the journal entry for cost of goods sold. Okay, now one thing to keep in mind when it comes to product cost is the product cost and the expensing piece might not happen in the same period. Okay, so you might have spent all that money into direct material, direct labor, and manufacturing overhead in this period, but it might not be expensed up until next period when the product is sold. Okay, so your product cost is necessarily made up of three things: your direct material, which is DM, direct labor, that is DL, and your manufacturing overhead. All of these three costs will be included in the cost of your inventory. Now, when we think of our balance sheet and we think of our inventory, the inventory can exist in three different stages. Okay. A manufacturing business is converting the raw material into finished goods. So when the raw material moves from raw material to finished goods, it could be on a production line at different stages. So raw material is your incoming or your input material. Okay. It's not being processed. Work in process or your WIP inventory is something that is on your manufacturing line. It's neither raw, it's nor finished. It's somewhere in between. So it's being worked on. That is your work in process inventory. Once your finished goods is ready, then that is your final good that you have ready for sale. That's your finished goods. So your inventory could sit at three different stages onto your balance sheet, which is your raw material, work in process, and or finished goods. On the other side, okay, sorry, a quick reminder with your product cost is it will only be expensed when your product is sold. That's when you debit cost of goods sold and credit inventory account. Only when those products are sold. On the period cost side, anytime the cost is incurred, it is expensed in the same period. This cost can never go onto your balance sheet or never can be inventoried. It always have to be expensed in the period that the cost incurs. It will be recorded onto your income statement, and as we all know, those expenses will reduce your net income. Okay, this is some further discussion with regards to our manufacturing costs. So our total manufacturing cost, once again, is made up of our direct material, direct labor, and manufacturing overhead. Now, your direct material or your material can be direct or indirect. Direct is anything that you are able to trace it back to an end product, to a unit. Okay. For example, think of a seat on an aeroplane. So that the material that goes into the seat that you can directly trace is the plastic that goes on the handrails, the amount of fabric that went into it, the material used for cushioning. Okay, so those are direct material costs, something that you're able to establish a one-to-one relationship is your direct material. But in order to make that same seat on the aeroplane, you also need some screws, you need some glue. Okay, so those kind of cost which exist, but due to cost benefit or some other limitations, we are not able to trace it back to the product, are then treated as indirect material cost. So the material was used, but it's not directly related, or you cannot directly trace it to the finished product. So it becomes indirect material. Now, the same idea applies to your labor as well. So your direct labor, so your factory labor cost that can be traced to your finished goods is your direct labor cost. An easy way to think of that is through touch labor. Somebody who is working on your production line, they are actually working on the product. So, assembly line workers at your manufacturing plant is a great example of direct labor. But if you think of all the people that work at these manufacturing facilities, it's not just the people working on the production line. There are other positions or other people working to support your direct labor. For example, you have got supervisors, you got janitors, we have material handlers, or the security personnel. So the work these guys do is equally important, but it's just that we cannot establish the one to one relationship between the cost of a janitor or the cost related to the janitorial services to the finished product. Hence, it ends up becoming indirect labor cost. Now, other thing to keep in mind is the idle time and overtime premiums. Now, companies generally tends to um, pay for the idle time as well as for the overtime. Okay, the overtime can be a time and a half or twice the regular time, depending on the company policy. So, how is that to be treated? It really depends on the job. If the company can trace the idle time and overtime premiums to a specific job, then it becomes direct labor. But if the company does not have the ability or does not want to um, establish that one-to-one relationship, or if there are multiple jobs that are running simultaneously on the production line, and the company doesn't have the ability of establishing that one-to-one relationship. So if there is no particular job where the idle time and overtime premium is related to, then in those cases, this will be treated as indirect labor time. Now, if you think of the manufacturing facility, so as I was telling you guys, so the manufacturing facility is where the product is actually made. Okay, so in order for us to make the product, we need material, we need labor, direct, indirect, both. Okay, now over and above these costs, we also have to pay the rent for the building. There is depreciation, there is heating, there is lighting cost, there is property tax, there is insurance. So, how do we treat all of that cost? Manufacturing overhead is different than your selling and administrative cost. Your selling and administrative cost is your advertising, sales salary, accounting, secretarial services, the salaries for IT personnel. Those are all of your um, head office cost, or we also call them as support services. So these are non-manufacturing costs. So these costs are expensed as they incur. Okay, this is another way of looking at our manufacturing cost. So your manufacturing cost is also called as your product cost or your inventoriable cost, which again is made up of our direct material, direct labor, and manufacturing overhead. Now, material that you can physically and conveniently traced to an end product is your direct material. Likewise, any labor cost that you can physically and conveniently trace to a particular end product then becomes your direct labor. So your direct material and direct labor, altogether, those two items are referred to as prime cost as well. On the other hand, if we take our direct labor and add our manufacturing overhead, which will be your insurance, your taxes, anything that is indirect. Okay. Now keep in mind your indirect material, indirect labor, factory utilities, all of that cost, anything that is outside of your direct material and direct labor. Sorry, my apologies. I think on the prior slide here, okay, so your manufacturing cost is your direct material, direct labor, and your manufacturing overhead. But your manufacturing overhead, just to clarify, is anything that is outside of direct material and direct labor. So anything that is indirect, whether that is indirect material or indirect labor, would be part of your manufacturing overhead. So our direct labor cost plus our manufacturing overhead, which is all of our indirect cost, then gives us our conversion cost. Okay, so your prime cost is your direct material, indirect labor. Our conversion cost is our direct labor plus our manufacturing overhead, and your manufacturing overhead is indirect material, indirect labor, and your manufacturing overhead pieces. Your non-manufacturing overhead, or as we said, the overhead that does incur at your head office, and that is just so that we can understand what we're talking about here, are generally differentiated between two pieces. One is the marketing and selling cost. This is all the cost that is necessary for your marketing and sales team to secure customer orders and get the finished product or service into the hands of the customer. Okay, so things such as your sales commission, advertising, depreciation, delivery equipment depreciation, your finished goods warehouse, so on and so forth. On the administrative cost side, all cost with the general management of the company as a whole, such as the executive compensation, executive travel, secretarial services, research, depreciation of office building and equipment, all of that is treated as administrative cost. Okay, so we are looking at in-class example, which is E2-1. The cost below all relate to sounds good. A company based in Alberta that manufactures high-end audio equipment such as speakers, receivers, CD players, turntables, and home theater systems. The company owns all of the manufacturing facilities, which is their building and equipment, but rents the space used by non-manufacturing employees, which is accounting, marketing, sales, and human resources. So here we are looking at different type of cost, and for each cost we will indicate whether it would most likely be classified as direct labor, direct material, manufacturing overhead, marketing and selling, or administrative cost. So we are going to go through cost classification necessarily. So our first item on the list is depreciation, taxes, and insurance on manufacturing facility. So, as we said, we are going to first determine where the cost is originating and then decide on how it should be treated. So, if we look at this cost, your depreciation, taxes, and insurance on the manufacturing facilities. So, your cost is originating at the manufacturing site. Okay, that means this becomes a product cost. Now, the question is, if it is a product cost, then is this direct material, direct labor, or manufacturing overhead? Now, your depreciation, taxes, and insurance, if you look at these items, they have nothing to do with direct material. They have nothing to do with your direct labor, which means they end up becoming part of your manufacturing overhead account, which is your MOH. Number two, rent on the office space used by non manufacturing staff. Now, the giveaway here is the non manufacturing staff. Okay, so this cost is not originating at the manufacturing facility. Any cost associated with non manufacturing um, locations are then treated as period cost. So, in this case, the rent for the office space could potentially be related to marketing and selling expense or related to administrative expense. We just don't know here because it's not specified who is using the office. So we are going to put this against the administrative cost. So which will be period cost and it will be expensed in this period. Number three, salaries paid to the employees who produce the audio equipment. Okay, now this cost is originating at the manufacturing facility. We are talking about salaries to the employees, and these employees are producing the audio equipment. Because we are able to trace this cost back to the end product, it becomes our direct labor cost. Number four, cost of the glue used to fasten the company's logo to the grill used on all of its speakers. Okay, now this company is manufacturing speakers, receivers, CD players, turntables, and home theater systems. Okay, now this is the material that was used in production. So we know that the cost is associated to the manufacturing facility. We know we are looking at the material cost. The only thing we have to determine now is whether this is direct material or indirect material. So here, the cost of the glue that is used to make these speakers is an indirect cost. It might not be worth the time or the cost associated to trace this cost back to the end product. So we are going to take that as indirect material, and indirect material becomes part of your manufacturing overhead account. Number five, the cost of online advertising. Now, online advertising or any sort of advertising has nothing to do with your production process, which means this cost is associated with non-manufacturing facility. Any cost associated to non-manufacturing facility is treated as period cost and it is expensed. So now the question is whether it would be marketing and selling expense or administrative. Because we are talking about advertising, we will record this cost into marketing and selling expense. Number six, salaries paid to the accounting employees. Now, Accounting employees have nothing to do with the manufacturing facility. They are seen as a support function. They are helping run a business, but their work has no bearing on the actual manufacturing process. So this cost is associated to non-manufacturing location. So that means it's going to be expensed. Because the salary is paid to the accounting employees, they are not part of the marketing or selling teams, which leaves us with administrative expense category to plug this in. Number 7, salary paid to the production manager who supervises the manufacturing activities for all products. Now, this cost is originating at the manufacturing facility because we are talking about production manager, and the production manager must be at the manufacturing facility. But the salaries paid to the production manager cannot be directly associated or can be traced back to a particular product. Hence, it ends up becoming indirect labor. That anything that is indirect, whether it's indirect labor or indirect material, then becomes part of your manufacturing overhead account. Number 8, cost of plastic used for turntable dust covers. Now, this cost is also originating at the manufacturing facility. We are talking about cost of plastic, which is a raw material based on the product that the business is making. And you should be able to trace back the cost of that plastic to the actual product, which means we are looking at direct material cost. Of course, that is assuming that you can trace it back to the end product. If the question changes and there is any indication that the cost of the plastic cannot be traced back to the product, in that case, it will become indirect material. And as we said earlier, anything indirect becomes part of your manufacturing overhead account. Number 9, bonuses paid to sales staff for meeting their monthly sales goal. Now, this cost is originating at a non manufacturing facility. We are talking about the sales team, so any bonuses or any salaries paid to the marketing and sales staff is a period cost and it becomes part of marketing and selling account. And finally, we have salaries paid to the manager of the human resources department. The human resources, again, that cost is originating at a non manufacturing facility. It has no bearing on the manufacturing facility or the manufacturing of the product. So this will be a period cost and it will be expensed. Human resources does not fall under marketing and selling, which means we are only left with administrative cost to take this in. Okay, so this is half of the coverage that we were going to cover in chapter 1 and chapter 2, but this is where we will break the recording for now and come back, record another session for rest of the slides in these chapters. So now, if you recall from our prior conversation, we said the variable cost is something where the per unit cost remains the same, but the total changes because it's tied to the activity level. So variable cost varies proportionately with the change in the level of activity. So some of the examples of that is your direct material and your shipping cost. On the other hand, though, your fixed cost is constant in total. So, regardless of the changes in the activity level, your fixed cost remains the same on a total basis. Okay. On a per unit level, it could change. So some of the examples are your monthly rent insurance, your property taxes, and any such items which will remain constant on the total. Now, a mix of both of these. Now, there is another type of cost referred to as mixed cost. Mixed cost is something that has features of a variable cost as well as fixed. So it has elements. The total mixed cost is made up of a fixed piece and a variable piece. So something like the salesperson's salary that includes a fixed portion, which is the base salary, plus a variable portion, which is tied to the commission on sales. Okay. Now, this concept of mixed cost is explored further in chapter 3. So we will discuss this in chapter 3. At that point in time, we will look at our total mixed cost and try to segregate between the fixed and the variable pieces. So we'll talk more about this in chapter 3. Now, as far as your cost behavior goes, now we are saying that your variable and fixed cost exist, but they are only going to behave in that fashion as long as your activity level is within the relevant ranges. So that is the assumption on which our entire course is based off of. Okay. Now, technically speaking, no cost is fixed, right? But the way we look at the fixed cost is if it is within the relevant range, then it will be treated as fixed cost. So that is an underlying assumption for this course that we are working with. I have shown a table summary of the cost behavior here. So the way our cost is behaving, if you look at your variable cost, your total variable cost will increase or decrease, and it will be in direct proportion to the changes in your activity level. So if your activity level goes up, your total variable cost will go up. Activity level drops, so will the total variable cost. Okay, that is the total. But if you look at it from the per unit perspective, the variable cost will remain the same. So in the first half of the course, we talked about, or of the class, we talked about the option of either buying a transit ticket or getting an Uber or a taxi. Okay. So you might want to go back and refer to those examples once again. Fixed cost is not affected by the changes in activity level as long as they are within the relevant range. So the fixed cost, the total remains the same, but depending on the activity level, the per unit cost would change. So if you produce higher number of units, your per unit cost will work out to be lower. If you produce lower number of units, then the per unit cost will work out to be higher. So these are some of the basic characteristics of your cost elements that you got to understand. Our direct versus indirect cost. Now we need to assign our cost for many reasons. Okay, we want to price our items. Okay, you want to price a product. You want to determine profitability of a segment or of a division or of a department. You want to analyze that information or you want to control your spending. So the need for assigning cost is different. It really depends on what type of analysis you want to do. Okay. Now, a cost object is something for which the cost data is needed. Now, that could be a customer, a product, a job. Okay. It really depends on what is the type of analysis you are looking at. So, depending on the level of analysis, the cost can be direct or indirect cost. Okay, we touched on this one when we were looking at the direct and indirect cost in the first half. So we were looking at the factory manager's salary. Now, if you think of this, the factory manager's salary is treated as indirect cost or the indirect labor cost to be precise. Okay. Um, okay. So that is if the cost object is a particular batch that is manufactured. But it would be treated as direct cost if the cost object is the entire manufacturing division. So the definition of a cost being direct or indirect depends on your cost object. Okay, so what we want to do is we do not want to memorize these transactions, but we want to look at the idea as to what makes a cost direct or indirect. Okay, so continuing with the same idea, our direct cost is cost that can be easily traced to a particular cost object, such as your direct material and direct labor. Okay, now both of those do have direct word indicated in that, and that tells you it's a direct cost, something that you're able to easily trace back to the product. On the other end, the indirect cost is something that is not easily traceable to a particular job or a particular project. Okay, so in that case, we have MOH that is allocated to a particular job. The way to allocate these manufacturing overhead is something that we will cover in the subsequent chapters. So let's not worry about that just yet. Okay, but do realize that the indirect cost, which goes into your manufacturing overhead, they will be allocated to the jobs on some basis. Then we have common cost, a cost that is incurred to support number of cost objects but can't be traced to a particular object individually, is treated as common cost. For example, the same factory manager's salary will become common cost to all the jobs produced. Our differential opportunity and sunk cost. Now, we did talk about our differential opportunity and sunk cost in the first half with an extensive example. So I would encourage you to go back and listen to the first half to review that example and see what that means if you need a quick refresher there. But we're just covering this one more time. So your differential cost is the difference between two alternatives. So when you have option one and option two, what is the cost difference between those two? The flip side of differential cost is differential revenue. The incremental cost is the cost that is higher or lower between the two or more alternatives that you are considering. Our opportunity cost is the potential benefit that you're giving up by selecting one alternative over the other one. And your sunk cost, as we had talked about earlier, is something that is already happened. It's a transaction in the past. That money is already spent. So no matter what decision you take, the sunk cost is irrelevant. That transaction was in the past, so nothing we do is going to change that. So sunk cost should never be a consideration when it comes to your decision making. All right, so we are looking at example E2-7. So Performance Edge, PE, is a consulting firm that helps companies develop employee recognition programs. It maintains a large inventory of companies can give to prizes companies can give to deserving employees. Because of growth in demand for its services, PE is considering selling its existing warehouse used for storing the prize inventory and leasing a new larger warehouse facility. The existing warehouse has a large parking lot that was newly paved last year, and PE rents about 30% of the parking spots to occupants of adjacent properties. The new warehouse is expected to be much more energy efficient and is larger than PE currently requires to store inventory. As a result, if they make the move, management plans to sublet about 15% of the space for the next 3 years. The new warehouse is also expected to require less maintenance, but because of the additional size, two new warehouse employees will be hired. So, our required is for each of the items below indicate by placing an X in the appropriate column whether it should be considered as differential cost, opportunity cost, or sunk cost in the decision to move into the new warehouse. If none of the categories apply for a particular item, leave all columns blank. And the first item has been completed for our reference. So this is our data set. So the first example, which is the cost of electricity for the warehouse. Now, the company has a choice of either being in the existing warehouse or they can move to the new warehouse. Okay, now the new warehouse is more energy efficient. So the cost of electricity for the warehouse becomes differential cost. Okay, so that is the cost difference between two alternatives. So the first item we are looking at is to sublet revenue for the new warehouse. Okay, now the new warehouse is bigger than what they require. So the company plans on subletting a portion of that. So the money that comes in from subletting that becomes your differential revenue. Lease payments for the new warehouse. Okay, now your lease payments, which is different between the existing warehouse and the new warehouse, is your differential cost. Okay, the lease payments will be different. We don't know if there were existing lease payments on the old property, but on the new one, we definitely know that there is lease payments attached to that. So that will be an additional cost for you to consider, which makes it a differential cost between option one, which is staying in the existing property, and option two, which is moving to the new warehouse. Number three, net book value of the existing warehouse. Now, if you folks remember, your net book value is the cost of your asset minus your accumulated depreciation. That difference is your net book value of the asset. Okay, so net book value of the existing warehouse, that is sunk cost. Whether the company decides to stay in the existing space or they decide to move into the new space, it does not change the net book value of the existing warehouse. There is no strings attached to that. There is no bearing on the decision we are making, which makes this a sunk cost. Sunk cost is something that should never be relevant for decision making. Number four, sales proceeds from selling the existing warehouse. Okay, now the sales proceeds, so let's say if the company does move from existing warehouse to the new warehouse, they decide to sell the existing warehouse and the money coming in from that is your sales proceeds. Now, technically speaking, your sale is not a revenue. When you sell a capital asset, that is cash inflow, but that is not your revenue item. But here our textbook is indicating this to be a differential revenue, so we will go ahead with that. Okay, although you can very well make an argument that this is a capital transaction and it's neither of these items. It's neither differential revenue or differential cost, opportunity, or sunk. Warehouse maintenance cost. Now, warehouse maintenance cost seems to be different between the existing option of staying in the old warehouse or moving to the new one, which makes it a differential cost. Warehouse staff wages. Now, if the company does decide to move into the new warehouse, the question did tell us that they would need additional staffing. Because there is additional cost associated to that, it also becomes differential cost. Paving cost for the parking lot of the existing warehouse. Now, whenever the company spent the money on paving the parking lot for the existing warehouse that they are in, that transaction was in the past. No matter what we decide today, whether to stay at the existing facility or to move to the new one, that money is not coming back. That money is spent, it's gone. That's why it should not be relevant for decision making because it is sunk cost. And finally, we got parking lot revenue from the existing warehouse. Now, if the company does decide to move into the new warehouse, then they are able to um, recognize some revenue from the parking lot rental. Now, that item can be viewed as an opportunity cost, or you can make an argument that this is differential revenue. You could argue for one or the other, they are both correct. So that was example 2-7, where we looked at a bunch of different cost items to determine whether that is differential cost, differential revenue, opportunity cost, or sunk cost. Okay, further on in this chapter, we will be looking at our cost of goods manufactured. Now, if you think of your cost of goods manufactured, the cost that goes into making a product is your direct material that is used in the process. On that, we add our direct labor. Over and above our direct cost, which is your direct material and direct labor, we then add our manufacturing overhead. Just to quickly recap, our manufacturing overhead is the indirect material, indirect labor, and other factory cost, okay, such as depreciation, insurance, utilities, property taxes, so on and so forth. Okay, any cost that was incurred at the factory level or the manufacturing level, which does not belong to direct material or direct labor, then becomes your manufacturing overhead. So, in addition of direct material, direct labor, and manufacturing overhead gives us our total manufacturing cost. However, with this manufacturing cost, all the money that we have spent in this period, some of that money was spent on completing the work in process inventory. So the items that were already um, on the production line. And there might be some items still on the production line which hasn't been converted to finished goods. So if we take our total manufacturing cost, add our beginning work in process, and deduct our ending work in process, that will give us the total cost of goods manufactured. So total money the business has spent in this period for manufacturing the goods. And when we say this period, the period could depend on the company. It could be it could be monthly, it could be quarterly, or it could be an annual. All right. So cost of goods manufactured is the total money spent by the business for manufacturing goods in that period. Okay, then we are looking at our schedule of cost of goods manufactured. Now, your schedule is made up of our direct material, direct labor, and your manufacturing overhead, right? So we were just talking about our cost of goods manufactured on a higher level. But when we are making a schedule of cost of goods manufactured, we need a little bit more detail. So when we talk about a direct material, our direct material starts with the beginning raw material inventory. Okay, unless it's the first year of operations for the business, in which case your beginning raw material inventory would be zero. Okay, but that rarely is the case. So we start with our beginning raw material inventory. Then we add all the new purchases of raw material in that period. That gives you your raw material available for use. And out of that total raw material that is available for use, if we deduct the raw material that we still have on hand, which is your ending raw material inventory, the resulting difference is the raw material that was used in production, which necessarily is your direct material. Direct labor is a fairly easy concept. So, direct labor, the company needs to maintain records on cost spent for direct labor. Okay, necessarily the time cards or some kind of payroll entry system to track that information, um, where we can trace the cost directly to the product. And then comes our manufacturing overhead. Okay. Now, manufacturing overhead, as we said earlier, are all the indirect material, indirect labor, and other factory cost. So, in this example, we have insurance for the factory, indirect labor, machine rental, utilities for the factory, supplies, depreciation for the factory, and property taxes for the factory. Okay, so that is your total manufacturing overhead. Now, if we add your total direct material, direct labor, and manufacturing overhead, that gives you your total manufacturing cost. So, your direct material, direct labor, and manufacturing overhead gives you total manufacturing cost of 820,000 in this case. Out of that total manufacturing cost, we are adding our beginning work in process inventory and deducting the ending work in process inventory to determine the actual cost of goods manufactured. So in this period, in this case, the company has spent $850,000 on cost of goods manufactured, which accounts for your direct material, direct labor, and manufacturing overhead. Okay, so now we are looking at example P2-25. Now, in this example, we have four cases. They have given us some of the information with regards to your schedule for cost of goods manufactured. So there is direct material, direct labor, manufacturing overhead. Okay, so the addition of direct material, direct labor, and manufacturing overhead would give us our total manufacturing cost. Out of that total manufacturing cost, if you added beginning work in process inventory and deduct the ending work in process inventory, then you would have the resulting cost of goods manufactured. So you got to understand the flow of information here in order to determine the missing pieces. So for case number one, our direct material is given to us at $5,600. Direct labor is $1,600 and manufacturing overhead is $8,000. So addition of these three is your total manufacturing cost of 15,200. Now, if the total manufacturing cost is 15,200, then we had to add the beginning work in process inventory, but we don't know what that is. So that's our missing number. So you can convert this into a mathematical equation and work it, or you can determine a plug here if you know the flow of your information. So 15,200 plus, let's say your beginning work in process inventory is assumed to be X, minus your ending inventory or your ending work in process inventory is 3,200, should equal to your cost of goods manufactured of 14,400. So if you solve for X, we are looking at adding your cost of goods manufactured and your ending work in process inventory and finding the difference between 17,600 and your total manufacturing cost. The other way to look at that is if you take 15,200 as your total manufacturing cost plus $2,400 of WIP minus $3,200 of ending WIP should leave you with cost of goods manufactured of 14,400. For case 2, our direct material and direct labor is given to us. We don't know what our manufacturing overhead is, but we do know that the sum of these three items, your direct material, direct labor, and manufacturing overhead, the total manufacturing cost adds up to 28,800. So all we need to do in order to determine our missing information is add your direct material and direct labor, which works out to be $15,000 here, is deducted out of total manufacturing cost of 28,800. So our manufacturing overhead must have been 13,800. Our total manufacturing cost of 28,800 plus our beginning work in process minus our ending work in process of 4,000 gives us our cost of goods manufactured of $26,000. For case 3, we have our direct material for 6,600. We are missing the direct labor, but we know that our manufacturing overhead is 7,700 and our total manufacturing cost is 19,800. So out of the total manufacturing cost of 19,800, if 6,600 was for direct material and 7,700 is for manufacturing overhead, then the remainder must be for your direct labor, which happens to be $5,500. Your total manufacturing cost for case 3 is 19,800 plus your beginning work in process inventory of 2,200 minus your ending work in process, which we don't know what it is. Let's assume that's X, gives us a total manufacturing or the cost of goods manufactured for 17,600. So if we solve for X, 19,800 plus 2,200 minus 4,400 gives us total cost of goods manufactured for $17,600. And finally, for case 4, we do have our direct material stated at 7,600, direct labor for 2,900, manufacturing overhead for 20,000. So all of those three added together gives us our total manufacturing cost of 30,500. Now 30,500 plus X, which is your beginning work in process, minus 1,900 should give us our total cost of goods manufactured of 29,900, which means our beginning work in process must have been $1,300. Okay, so now we are looking at calculating the cost of goods sold. So when you're calculating your cost of goods sold, your cost of goods sold is the cost associated to the items that you're selling. Okay, this is the inventory items that you're selling. So remember your product cost, which is your direct material, direct labor, and manufacturing overhead, is your inventory cost. It only moves from inventory cost into cost of goods sold or a expense account. So COGS is an expense account, cost of goods sold, when that inventory is sold. And the inventory is only sold when it's finished goods. So whenever you're talking or thinking of your cost of goods sold, always think of your finished goods inventory. So the business would have started with some sort of beginning finished goods inventory. On that, we would add our cost of goods manufactured. That is what we just calculated in our prior example. Okay, so the total money spent by the business for manufacturing in that particular period, that is your cost of goods manufactured. Whatever we had calculated earlier would flow through here. Then the addition of your beginning finished goods inventory and your cost of goods manufactured gives us our total cost of goods that is available for sale. Out of that, if we deduct our ending finished goods inventory, which is still on hand, if the inventory is sitting with you, that means it's not sold. So we are taking away the ending finished goods inventory that is still on hand, and that should give us our total cost of goods sold in that particular period. Then we are looking at income statement for a manufacturing company. Now, with any financial statement, always a good idea to indicate the name of the business, the name of the financial statement, and the period that it represents. Okay, so that's necessarily the title of your statement. So this is a manufacturing company, Graham Manufacturing. So we have the total sales that are indicated. Then we are looking at our cost of goods sold section. So your cost of goods sold section is what you were just looking at in the prior slide. So your beginning finished goods inventory plus your cost of goods manufactured gives you your total goods available for sale. Out of that, if you deduct your ending finished goods inventory, then you have your cost of goods sold, which in this case happens to be 800,000. So sales minus your cost of goods sold is your gross margin. Okay. Now, if you recall from accounting 2121, this is gross margin or gross profit as it was referred to. Okay. So necessarily what you're saying here is the company has spent $800,000 on manufacturing these goods and they sold those goods for 1.5 million. So they made a gross margin of 700,000 on these goods. Okay. Now out of that 700,000, which is your gross margin, we then deduct our operating expenses or our period cost, which primarily are into two categories, that is your marketing and selling expenses and your administrative expenses. Okay, so your gross margin of 700,000 minus your total operating expenses gives you your operating income of $150,000 in this case. Okay, so P2-25, this is the second half of the example. So we were just looking at these four cases with regards to your cost of goods manufactured schedule. The second half of that example is with regards to your income statement. Okay, so some of that information will flow through from earlier examples. So you might want to make a note of those numbers. And this probably would be a good place for you to pause this video and take a stab at this example. Try to do it yourself. Okay, so for case one, we have our sales at $20,000. Our beginning finished goods inventory was $4,800. The cost of goods manufactured in that period is $14,400. So your beginning finished goods inventory plus your cost of goods manufactured gives us our total goods available for sale. So $4,800 plus $14,400 gives us $19,200 of total cost of goods that are available for sale. Now, out of that, if we deduct our ending finished goods inventory, okay, so we had total cost of goods available for sale for $19,200, but out of that, $7,200 worth of finished goods inventory is still on hand, which means the difference of $12,000 must have been the cost of goods that we sold. Your gross margin is your sales of $20,000 minus your cost of goods sold. So we have spent $12,000 for total cost of goods sold, and these items were sold for $20,000. So we ended up making gross margin of $8,000 in this scenario. Out of that gross margin, if we deduct our selling and administrative expenses of $4,800, then our operating income that we are left with is $3,200. Now, case two is a little bit tricky. Now, in case two, we have the sales of $46,000. We don't have beginning finished goods inventory. We don't have cost of goods manufactured. We don't have cost of goods available, and we are missing gross margin as well as selling and administrative expenses. So we will first go with what's obvious. Okay, we have lots of missing information under case two, but you got to keep in mind or recognize the flow of your information. So we, up until this time, up until you get onto your income statement, you already have prepared your cost of goods manufactured schedule. So if you go back to your earlier example where we were looking at P2-25, in that case, under the scenario 2, we had already calculated our cost of goods manufactured for $26,000. So all we are doing is bringing that information here. All right, so it's a flow through from your cost of goods manufactured. Once we have this information, then we can calculate our cost of goods available for sale. Okay. Okay, if our cost of goods available for sale is 35,100, okay, just to clarify, your 35,100 is coming from your cost of goods sold of 30,500 plus your ending finished goods inventory of 4,600. So those two numbers added together is your cost of goods that is available for sale, which was 35,100. Now we are working our way backwards. If your cost of goods available for sale is determined, we already knew our cost of goods manufactured, then we are calculating the plug. Okay, so 35,100 minus your cost of goods manufactured for 26,000 gives you your beginning finished goods inventory of $9,100. Okay, we still got to figure out our gross margin and our selling expenses. Now we are making progress. We have a bunch of information here. As we said, your gross margin is the sales minus your cost of goods sold. In this case, we already have the sales of 46,000. We already know that our cost of goods sold was 30,500. So our gross margin must be the difference in those two numbers, which is 15,500. Out of that gross margin, if we deduct our selling and administrative expenses, then we are left with operating income of $6,300, which means 15,500 minus 6,300. The plug must have been $9,200, which then becomes your selling and administrative expense. For case 3, our sales are given to us at 33,000. Your beginning finished goods inventory is 7,700 and your cost of goods manufactured is 17,600. So if we have our beginning finished goods inventory and cost of goods manufactured, then those two numbers added together gives us our goods that are available for sale for 25,300. Now, out of that 25,300, we have to deduct our ending finished goods inventory, but we have no idea what that looks like. But we do know that cost of goods available for sale minus ending finished goods inventory gives us our cost of goods sold, which means the difference between 25,300 and 19,800 is your ending finished goods inventory. So out of $25,300 worth of goods that you had available for sale, you as in the business is still left with $5,500 worth of finished goods inventory on hand. So their total cost of goods sold in the period is 19,800. Your gross margin is your sales of 33,000 minus your cost of goods sold gives you your gross margin of 13,200. Out of that gross margin, if you're only left with the operating income of 3,300, then the differential must have been your selling and administrative expense. And finally, your case 4, sales are given to us. Beginning finished goods inventory is stated. Your cost of goods manufactured is stated. So if we put together our finished goods inventory and cost of goods manufactured, then that gives us our cost of goods available for sale at 38,500. Out of that, if we deduct our ending finished goods inventory, then we are looking at our cost of goods sold for 31,800. Your total sales of 47,500 minus our cost of goods sold for 31,800 gives us the gross margin of 15,700. And out of that, if we deduct our selling and administrative expense of 9,500, then we are left with operating income of 6,200. So with examples like these, you got to be really thorough with the layout of your manufacturing schedules and your income statement layouts. So do make sure to take some time in practicing these layouts and schedules. This is our last slide. We are not doing these additional practice problems here, but I do recommend that once you have reviewed this video, please go ahead and try these practice problems. We will try to do as many of them in our time together when I see you guys on our Tuesdays and Wednesday classes. At that point in time, we will try to get through as many of these as we can. For anything that we are not able to cover in class, I will post the solution on the Blackboard, so please make sure to refer to those. I hope you guys do take the time to review these recordings, and I hope to see all of you guys for the live session. Talk soon. And this is all we had for Chapter 1, Chapter 2 for Week 1 coverage. I will continue